Hi, we're going to do the topic for the other payable, other receivable. So three areas that to cover: recognize the importance of the matching cost and the revenue under the matching concept, prepare the ledger and the journal entry to adjust accrued and the prepaid expenses, prepare the ledger and journal entry to record accrued and prepaid income. Okay. Why is important of matching cost and the revenue? Because end of the year in the actual business, most of the time the business will not able to pay all the bill or receive all the money. So that's why we need to do the adjustment end of the year, whether we have outstanding or whether we have any pay in advance. Pay in advance means that we have not get the service, but we pay them pay upfront the money. Outstanding means that we use the service but yet we didn't pay. Matching concept under the accounting principle, matching concept means that event that change a business financial statement are recorded in the period in which the event occurred, rather than the period in which the business received or pay cash. So means that in other words is for the matching concept, we are talking about the expenses incurred match against the revenue earned. Revenue earned in the same period, or in the same period, rather than we pay or we receive. So for example, revenue are recognized in the period which they are earned, and expenses are recognized when they are incurred. What is the earn? What is okay. In accounting, we have to differentiate. Let's talk about the revenue. When we say we earn, when we say we receive, these two are two different meaning. Revenue earned, it means that it could be you receive the money, it could be not yet receive the money, not yet receive, or maybe receive in advance. That is called earn. So when we receive money for the year, we recognize in our book. Not yet received, we also have to recognize because we already entitled for it. But when we receive in advance for the revenue, we have to minus because we are not entitled yet. It will become our liability. So revenue received means that it's the actual money that we are receiving. So this revenue received is part of the earned recognition. For expenses are recognized as incurred rather than the paid. Pay means that the actual money go out. But for incurred, it could be money, actual money out, or not yet, or pay in advance. This all can be happen for the meaning of incurred. Three scenarios. Okay, let's continue. Okay, in the exam, a lot of time they will ask us to do the adjustment in the income statement or statement of financial position. They provide us the additional information in the question. So this additional information is important. We must be clear what are they talking about in the additional information. The amount in trial balance for the expenses or other income mean already paid or received. Expenses should be debited and other income should be credited. That is from the trial balance that we have. The additional information provided by the question, what will be the impact on the adjustment? So let's go to the next slide. Additional information provided by the question, where they say owing, not yet paid, not yet received, or outstanding. These expenses or other income in the trial balance had to add the additional information amount to get the total amount to be recognized in the income statement. Whereas the amount in the additional information will appear as a current asset if other income not yet received, and appear as a current liability if expenses not yet paid. So two scenario happen. Okay, take note that if this additional information in the information saying that owed, not yet paid, not yet received, outstanding, means that for the income that not yet received, okay, owing, income owing, it will recognize as a current asset. But for the expenses, okay, expenses owing, not yet paid, okay, not yet paid, it will recognize as a current liability. Okay, let's continue. Next. If the question in the additional information saying that prepaid, pay in advance, or receive in advance, one is a pay, one is a receive. When we say pay in advance means expenses, receive in advance is means the income. So when we see this word in the additional information, we have to less the amount to get the total to be recognized in the income statement. And this additional amount in the additional information, it will be appear as a current liability if the other income received in advance. It will appear in the current asset if the asset is paid in advance. So there is the differences. You need to take notes. Okay, let's continue. Okay. So this is a general idea for you to look into it. So the type of the adjustment, which is under the statement of financial position point of view. When you have prepaid, means that pay in advance or receive in advance. Prepaid expenses is a current asset. Prepaid revenue is a current liability. Accrued, owing by the business or yet received by the business. Accrued expenses is a current liability, which is other like payable. Accrued income or revenue is a current asset, which is other receivable. Okay, let's move on. Okay. Double entry to adjust the prepaid or the accrued. When we have prepaid expenses, we will debit prepaid expenses, credit the expenses account. These prepaid expenses, we will go to the other receivable. So this amount will sit in the other receivable under the current asset. For the accrued expenses, we will debit the expenses account, credit the accrued expenses, and these accrued expenses will sit in the current liability under other payable. So there is the differences between these two. One is a prepaid expenses, one is accrued expenses. Generally, this is the expenses account. When we have balance brought down beginning of the year, this is the beginning of the year. If a debit side, that means we have prepaid in the last financial year for the current year expenses. But if we have balance brought down in the credit side, means last year we have outstanding not yet paid for the last year and bring to this financial year to pay. For this account, bank payment made during the year must be in the debit side. Income statement is the amount, the actual expenses incurred for the financial year and transfer to the income statement. End of the year, balance carried out in the debit side means that there is an owing amount not yet paid for the current year expenses. Whereas when we have balance carried out in the credit side, prepaid amount for the next financial year, but paid in the current financial year. So balance carried out, balance brought down must be always completed. So balance brought down in the debit side, it will be the asset, current asset, current asset. So carry down end of the year is a current asset. Balance brought down in the credit side is a current liability. This one, current liability. Okay. For the revenue account, if we have a prepaid revenue or income account, we debit rent receivable, credit prepaid rent receivable. Because this one, it will be our liability. We're going to pay back if we didn't provide the service. So that's why it's a liability. This one sitting in the current liability. When we have accrued income, that means we didn't receive the money yet. Accrued income will be debit, accrued commission received, which is an income account. And this account will sit in the current asset. This one is sitting under the other receivable. Whereas this one will be other payable. Okay, so commission debit means that increase the commission received amount in the income statement. So this is a rent receivable, which is the other income account. Debit balance what now is asset. This is current asset beginning year. This one will be current liability beginning year. Balance brought down debit means owing by the tenant in the last financial year. Balance brought down in the credit side received in advance in the last financial year for current year financial year rental. Position for this income statement and the bank is fixed. It will not change. Here is the debit side. Here will be the credit side. Balance carry down, balance carry down. This is referred to the year end of the year. Balance carry down in the debit means the current liability. If a balance carry down in the credit will be the current asset. So balance carry down, balance brought down, always must be complete, one set. That is for the other payable, other receivable topic that I would like to share.